On today's episode of Real Talk on Real Estate with Mark Phillips, your local realtor, we're going to cover the different types of loans that you can get for a home. I'm here today with my friend Jeff Tisdale of VIP Mortgage, and when we come back, we're going to explain the different types of loan, the qualifications that you need for those types of loan, and the size of that loan and what it can do as far as buying you into the home of your dreams. We'll be right back. Welcome back on Real Talk with Real Estate with Mark Phillips, your local realtor, and Jeff Tisdale from VIP Mortgage. We're going to cover now the different types of loans that you can get for obtaining a home of your dreams. There are several different types out there. Jeff's going to cover those kind of at a 50,000 foot level and tell you what it takes to qualify and the basic structure of those loans. So Jeff, on the first type of loan we talk about a conventional loan. Explain to the audience what that conventional loan is and the process of applying for it.
Well, applying for any of the conventional FHA or VA loans is going to be similar in the beginning with the loan application we talked about earlier with residence history and work history and so forth. And usually you can identify pretty early on if you're going to be going FHA, conventional, or VA. On the conventional, the new loan limits to be a conventional loan would be 453, 100. Anything over that number would be considered a jumbo loan, which is a whole other set of guidelines. Usually around you have to have a little better credit and more reserves. Conventional loans have anything from a 3% down, 5%, 10, 15, 20, or as much as you want down. So they have some great programs. A lot of people used to think conventional is always 20% down, but there are 3%, 5% programs available.
Okay. What about credit scores for qualifying for a conventional loan?
Well, typically we need at least a 620, but higher is better.
Okay.
Credit scores typically go to different categories for interest rates based on 20 points. So 620 to 640, 640 to 660, 680, 700, and so forth. Anything over 740 would be considered your best rate. So if you have an 800 or an 860 or a 740, it's all the same. So we look for at least a 620. But if you are down in the 620, 640 rate for credit scores, you might fare better on an FHA because FHA isn't going to give you as big of a hit on the credit for your interest rate with a lower credit score.
Okay. A couple of my past clients were shocked when they sat at the closing table and there was a little line item on the closing documents that said PMI. That stands for Private Mortgage Insurance, and they're wondering why they got to pay that. Would you explain to the audience what PMI is, what it applies, how it applies to that difference, and when it can disappear from your loan and you can save yourself some money?
Sure. So PMI, Private Mortgage Insurance, lenders have determined that if you have a 20% down payment, 20% equity in the home when you purchase the home, the odds of you going into foreclosure is very slim, almost zero. So the less you put down, the more mortgage insurance they want. They want a mortgage insurance company to help cover the bank's rear end against you defaulting on the loan. So if you put down 3%, it's going to be at a higher money factor than it would at 5 or 10 or 15. And if you put down 20%, it goes away altogether. Okay. This is also can be determined by what your FICO score is. So if you're putting a minimum down and you have a low credit score, your mortgage insurance will be much more expensive than if you put down 10 or 15% and you have a high FICO score.
All right, so I'm a client, I'm going to buy a home, and I put down 10%. Credit score is okay, but I still got PMI tacked on to my interest payments that I paid to the bank, or to you, or to whoever you sell a loan to. I understand that there's a point in time that it automatically disappears from my loan payment and my payment will drop significantly. Mm-hmm. When does that occur?
Well, under the Home Protection Act of 1998, there's two different ways that it can go away. Once your loan limit hits 78% of the original purchase price, the lender has to drop it. Okay. It has to fall off. When it hits 80% of the original purchase price, then you can ask for it to be removed. And typically they'll remove it as long as your mortgage payments have been on time. That's based off the original purchase price. Another way you can have it removed is if you are less than 2 years and the loan to value is at 75% of the market value, you can petition for it to be removed. It's not a guarantee.
So in that case, if the home is appreciating in value, so either I pay down the loan or the home is increasing in value, you can reach that
Right.
below that greater than 80% or less than 80% stake in the home, that you can have it removed then as well.
Cancellation using your current market value, Fannie Mae and Freddie Mac typically require that the loan has been seasoned at least 2 years and the borrower has had an acceptable payment history, and that the loan to value based on a current appraisal is 75% or lower if less than 5 years has elapsed since the original loan, or that the LTV on the current appraisal is 80% or lower if more than 5 years has elapsed since the originally closed on the loan. And you keep in mind that it's not the mortgage insurance company that removes the mortgage insurance, it's the lender who is servicing it.
Okay.
But they will go off of Fannie and Freddie guides, so there is a way to have the mortgage insurance removed under certain guidelines.
Excellent. The next type of loan we're going to talk about is a FHA.
Yes.
Tell me about an FHA. What's FHA stand for?
Federal Home Administration.
Okay. Government-sponsored program.
Absolutely.
Okay. And tell me about qualification, maximum amounts of loans, and down payments and stuff.
Sure. Well, FHA loan limits also recently went up, and here in Maricopa County, you can have a loan limit up to $294,515, which is kind of a goofy number. But
it's the government.
exactly. But you could buy $1 million house and go FHA. It's just the loan can't be over $294,515.
Okay.
Right? FHA is a great program in a number of different reasons. It's minimum down, 3.5% down, although you can put down more if you want. The interest rates are pretty good, and they also don't nail you as hard if you have lower credit scores. Another reason is if you're buying a condo and you have low credit scores, you're not going to get double dinged on any Fannie or Freddie products. They're going to hit you for the low credit score and that it's a condo. Well, you won't get that with FHA.
Okay.
So it actually is better than conventional in some situations.
All right. PMI on a FHA loan, can you remove it?
Never.
Never.
You used to be able to years ago, I don't know, 15 years ago or something like that. And they actually have two types of PMI. They have PMI, which is paid monthly, and they also have a thing called MIP, which is a financed mortgage insurance that's added onto your loan limit.
Okay. All right. Next type of loan we want to talk about is a VA loan. Who's eligible for a VA loan, and what are the qualifications for that?
Anybody that is in active military service, you get a certificate of eligibility and a DD-214 if you're honorably discharged.
Okay.
It's a great program. Good interest rates. They don't hit you as hard for credit scores. Again, like FHA, we're on conventional, they will. Like I said, zero down. One nice thing about the VA is if you are 10% or more disabled, they do not have the VA funding fee. And the VA funding fee is the VA's version of mortgage insurance, which is added on to the loan amount.
Excellent. The maximum on a VA loan?
Well, it's $453,100, which is the current conventional loan limit. But you can, again, you could buy $1 million house on VA, but you can do zero down up to the $453,100, and then you would have to put 25% down on the difference between the $453,100 and the sales price.
Okay, because a lot of my clients who were VA thought that that was the maximum limit, was $453,100.
Nope.
So you can buy more, but you're only going to pay 25% of that spread between $453,100 and the $750,000 home that you want.
Exactly.
So VA vets, you get a good deal from the government, which you should. We've covered the basic types of loan in this segment of Real Talk on Real Estate. Again, I want to thank Jeff Tisdale from VIP Mortgage for helping me. I'm the real estate guy. I'm not the money guy. That's why I get him in here to help you out. Again, if you have any questions, private message me, text me, call me, direct message me on Facebook. Be sure to like this post. Be sure to share this post. Also, check out Jeff's page on Facebook. and his website. And if you've got any questions about mortgage, get a hold of Jeff and we'll be more than happy to help you. Thank you for watching today, this episode of Real Talk and Real Estate with Mark Phillips. We'll see you next time. Thank you.
Thank you.